All right, good afternoon. How are you all doing today? Hopefully, very well. It's Thursday, a day before Friday, which is my favorite day of the week. Anyhow, going to get rolling with today's webinar. And as you all know, it is on the topic of retirement and taxes. And we are sorry, I noticed earlier that the kind of the cover was stating Medicare, which is one of our other webinars. Anyhow, I'm glad you all could make it. My name is Josh Crow, and I'm the owner of SunPath Financial, a retirement and wealth management firm here in beautiful Newport Beach, California, where it's been hotter than ever this last week. But we've been enjoying it nonetheless. So a little bit about my background, and then I'm going to go into some personal life stuff for you guys so you can get to know me a little bit better. Started the company about 5 years ago, but that's not where it all began for me. It actually began with my grandfather having called me into their tax business when I was just a young guy. I was probably 12 or 13, and they needed help filing and doing customer input. And so I found myself there. And at one point in the future, let me see if our webinar is working here. But at one point in the future, I went ahead and got licensed. At 18, you can get your license. And from there, sky was the limit. Started doing individual and corporate tax returns, all the fun stuff that you no doubt have experience with, especially considering this last quarter was tax season. And got interested in something that was a little different than taxes, which was IRAs. It's an above-the-line deduction. Many of you know what that is, an individual retirement account. It is a method for saving on a tax-deferred basis so that you deal with the taxes later. But anyhow, really like the idea of helping people accumulate their assets as opposed to decreasing their liabilities or reducing their liabilities as you do when you're preparing someone's taxes. And so went off and worked for a very large financial institution down in Irvine, California, and got my feet wet. Learned from some great mentors, guys that had been in the business for 30 plus years. Just an awesome team there to learn from. This company did offer several different services. They had P&C and life insurance, which is what they're really well known for. They did a bunch of different insurance types, but the one area that I really gravitated to was retirement planning. I had a knack for that. I liked getting into the details, and I really enjoyed making very large, complex, kind of financial strategies small and understandable for clients, being able to translate that. It's almost a second language. When you spend so much time in this world, you start learning a different language, and you got to be able to translate that into something that the public understands. And so that's really one of the things we're due here at SunPath, and that's a reason why we have the classes. But getting back to that, wanted to at one point kind of have our name on the building, but more importantly, specify in that niche of retirement planning. And it didn't seem as though we would get there with that previous company, considering all the services they had. And so I decided that we would leave there and start our own firm. Been in the business now on our own for 5 years, getting beyond those percentages you hear, some 90% failure in the first year for most businesses. We're now in the fifth, and we're going stronger than ever, and we're very thankful for that, and thankful for all our clients for allowing us to continue on for 5 years now. In the first year of getting on our own, I wrote a book on retirement planning. It was a little more specific to federal employees, but if you ever get your hands on it, the fundamentals of retirement planning are there, so you're more than welcome to have a read. So that was a great accomplishment for us in the first year. We went on to be written up in Forbes, had an article on retirement there. It got top 25 retirement articles for the year, so we were proud of that. And then a few years later, we got #1 producers in all of the United States with a relationship we have out in Scottsdale called Brokers Alliance. And really what that is a liaison, a partner between us and the large insurance companies that allow us to provide clients with life insurance and long-term care and things of that nature, where you have insurance involved. And so other than that, we've just been really pushing as hard as we can to build these great retirement plans for folks that need them, showing them their progress towards retirement, and then helping them manage that plan over time. You're going to spend 25, 30 years, hopefully more in retirement. And so you're going to need a guide to help you along the way, and that's what we do here at SunPath Financial. One thing I do want to mention about the class that you're engaged with today is we do a series of these. So we speak on Medicare, Social Security, retirement and income, retirement and taxes, as you're here today listening to. We also have an estate planner that comes in and gives a presentation on the importance of an estate plan and kind of a 101 things and how to prepare for having one put in place, and kind of the ongoing management of that estate plan as well. And so the idea is to educate the public, again, taking a very complex kind of industry and translating it into one that you guys can understand, because you didn't spend the last 15 years in the industry and we have, and then allowing you with that education to go on and make better decisions, right? A lot of the decisions you will make as it pertains to retirement will be irreversible. To give you an example, Social Security. Well, once you start that income, there is no going back. And if you start it early, you'll take a 25% haircut. That might not be the best decision for you. And some folks don't understand that there are other strategies that you can use in the interim to get you retired at 62, for instance, but to your full retirement age of, say, 66. That's 4 years you're going to need an income. There are ways to do that. And so we like to get people educated on several different, the core topics of retirement. We do not help people with the application process. That's what the Social Security Administration is for. Medicare, they also have their own administration to help you guys complete applications and make good decisions. We do have partners. So if ever you guys need a partner for getting your Medicare, because you'll need an insurance agent for that, you're more than welcome to reach out and we will push you off into the right direction. For everything else, though, those pieces that you make decisions on will come back to us as planners, as your retirement planner, as your wealth manager. We will have to deal with the consequences of those decisions. So getting an education is key. And so we welcome you guys and thank you for attending. Now, as far as my life on the personal side goes, I spend a lot of time here in the community, trying to get it acclimated here and knowing the community and who it is that as constituents of the business, as state attorneys, has kind of been a big relationship for us. But also the city council and things of that nature that we're a part of. We try to network as much as we can. Beyond all that, really spending time with girlfriend and dog. I have a dog. Her name is Nala. She comes up in every webinar, but she's a little miniature schnauzer. She actually spends time here once in a while at the office, which we love to have her. And then we'll do hikes on the weekends, and we'll do a couple of vacations, big vacations every year. That's kind of my life. As a matter of fact, we've got one coming up next week, and we are so glad to finally get away. Turks and Caicos, of all places, down there in the Caribbean. And so we won't be seeing you guys next week here on the webinars, but you got to get away in order to make all this stuff happen for you. I got to de-stress now and again. So again, thank you all for jumping in here with us today. Let me go ahead and I'm going to change the format of the presentation that you're watching and do something where you can see a slideshow in the background. And now if you're on one of these platforms or social media platforms where you don't have access to that presentation in the background, if you're not seeing it here in a moment, and it should pop up any second now, then you're going to want to find yourself to one that does. So Facebook, there's a presentation live there. LinkedIn, YouTube has kind of been another one that we've been using as of lately. And so you'll see the presentation pop up there in the background, and it's Retirement and Taxes webinar. And so I got to show a couple disclosures here, so I'm popping that up. I know it's really fine, but by SEC regulation and FINRA, we have to supply that to you guys before continuing the presentation. So there are two. I had the one up there for about 5 seconds, and now about 5 seconds on the second one. Okay, so moving right along, what are we going to cover in today's webinar? Well, let's take a look. First of all, taxes in the grand scheme of retirement. First of all, if you've ever been to any of our webinars, we like to kind of build up a big problem up front. And that way it drives the importance of not just maintaining your attention throughout the webinar, but also for whatever the future is of that topic. Taxes, many people feel as though they're going to rise here in the near future. And so we'll kind of start looking at that. And then second of all, we'll move to a simple approach on how taxes are calculated. So the importance of understanding the formula behind taxes is that you can start, when we begin making recommendations on how to reduce them, it will all make sense for you. The most favorable retirement income streams will come up next. So you're going to want to pay attention to that because many of folk, they'll kind of do things in reverse order as far as income goes in retirement. And that causes them a lot more tax during retirement as if they were, as opposed to doing it in the right order. Strategies to reduce your annual lifetime tax bill will be next. And then I will bring it all together there at the end. We can jump to a Q&A if you have some questions. You all are more than welcome to ask. So let's go ahead and take a look at taxes in the grand scheme of things. So first of all, looking at the slideshow here coming up, we had a lot of different representatives in the House over, as presidents over the last, 100 years or so. And some of these faces, no doubt, you'll remember. We had Reagan there and Clinton, Bush. We've had Obama. Can't forget Trump, right? Big personality. And then most recently, Biden. And despite the great leadership that has come forth from these individuals, the deficit, the U.S. deficit, has mostly remained the same. First of all, I want to start with the U.S. debt clock to show you guys, no different than your household. You've got income and expenses, and you're attempting to balance those, right? You always want your income to be higher than your expenses. That's healthy. The U.S. runs a very similar format. So if you look on the screen there, you'll see U.S., this is U.S. Federal revenue. And revenue is a simple function of GDP, gross domestic product. And what that means is in the U.S., we generate, from goods and from services sold, there is income that's generated. And as we know, the government taxes that income. Well, that tax revenue is what we use here as a country in order to cover things like Social Security and medical and our defense, right? And so that is our revenue that we generate from GDP. And then next we have our spend, right? So the U.S. federal spend as of 2020 was artificially higher than it has been historically. And that's because of all the stimulus pumped out via COVID to keep the economy stinted up. Last year was about $7 trillion. We see 6.69, so call it 6.7 trillion was the spend. And so our deficit, the difference between our income and our expenses, was about $3.2 trillion. Now, what happens with the deficit? Well, that's added to the U.S. debt, right? Now, looking at total deficit and surplus. So if we take a look over the last, call it 70 years or so, back to the 1940s, when World War I broke out, we see a pretty big hanging deficit there, right? Everything below that horizontal line is a negative. So if we look on the very left side, as low as 30% at one point in time. Now, everything below that horizontal line is a deficit, right? That means that our expenses were greater than our income. Everything above that horizontal line is surplus, though those were years where our income exceeded our expenses, was higher than our expenses. Now, for several years there, through the 1940s and the war, we saw a big deficit because the war has to be funded, so taxes rise to offset that, but just not enough to cover the cost of the war. Right after the war, we see some surplus as things got back online. We tapered back a lot of the expense from the war, and so we can see about 2 or 3 years of a surplus. And then we are back and forth there, almost at a balance for a decade or two. And then through the 70s, another deficit from about a 2-decade span. And then we ticked up there at the dot-com boom. And then pretty much from that point forward, we've been in the negative once again, all the way up until 2020, where we got to a deficit level that was almost equal to those seen back during World War I. It is projected by economists that over the next decade or two, we will continue to remain in a deficit that's equal to between 5 and 10%. Okay, so let's look at, like I said earlier, when you have a deficit, that has to be, there's an ongoing debt that's accumulating from that deficit. And as of now, if we look all the way back, 100 years or so, excuse me, this is a shorter time span. This is like 15, 20 years ago up until now. We see the debt was somewhat manageable, several trillion. But as of recent years, we've eclipsed 20 and we're up to nearly 30 now. As a matter of fact, we'll be just beyond $30 trillion. This slideshow will be updated, but that's as of the most recent stimulus package that we all received here a few months ago. the economy, well, businesses and individuals received. And so 28 trillion here on the screen, and relative to our total US GDP, what we generate here as a revenue, as not just the government, but as individuals and households, about 19.5 trillion. Again, we only, the federal government only takes a small percentage of the 19.5. But we're looking at $28 trillion as the current debt, closer to 30 now. And we can see that back on our U.S. national debt clock, right up there at the top left. And if you guys have never visited that website, check it out, usdebtclock.org, usdebtclock.org. It's really fascinating. And so the question is what options exist to solve the debt, our debt, this problem that we're faced with? Well, first of all, we have to solve the deficit. We got to get to a surplus, and we can do that in one of two ways. The easiest way to think about it is either you can increase your income or you can reduce your expenses. It's one or the other. And so if it comes to increasing income for the federal government, that would be raising taxes. That's to the left side. And if it comes to reducing our expenses, that would be cut spending, and that's to the right side. So let's take a look at, let's consider spending cuts. What would it take and where would it come from? How could we cut spending? In what area would we? So if we look at the chart here on the screen, this is federal spending as of 2019. It was 4.4 trillion. So I know I showed you guys about 6.7 in 2020. We went back 1 year to 2019 because that's more in line with an average. Typically, we're not spending $6.7 trillion, most of which came from stimulus because COVID was kind of an anomaly. And so if we look back at 2019, something that's a bit more average, we can see how that revenue we generated was spent, that 4.4 trillion, right? So first of all, about 23% of the allocation, spend allocation, is to Social Security. The next 26% or so is to medical. We can see that in Medicare and Medicaid, Medi-Cal, things of that nature. And then if we move over to the left where you see the orange slices of a pie, we see it's defense. And so that's about 30% combined between non-defense and defense. And then lastly, at the top in the gray, we see 8% to net interest, and that's the interest that the U.S. government pays on debt for us borrowing money from typically other countries. All right, so the question then becomes, if you were looking at this pie chart and we were to ask you to cut away some of the spend from any one of these areas, these are the major ones, where would you cut from? Well, first of all, let's take a look at Social Security. Can we cut spending in that area? We don't think so. And the reason is because there are more people retiring now than ever, and people are living longer than they had in the past, right? Not only are they living longer, well, most of that comes from medical advancements, right? And so they're living longer, and the longer that we live, the more dependent we are on that Social Security system. They have to continue to pay out. That system the spend become more expensive. So we don't think that Social Security will become less expensive. We think it'll become more expensive than anything, if anything. Moving on down to the lighter blue below where we have medical, same thing, right? A lot of what's keeping people alive longer is medical advancements. And we believe that those advancements will continue. And as people live longer, you'll experience more health issues, and you'll continue to need medical to cover those health issues. And therefore, it's this kind of repeating cycle. And we think that medical will also increase in cost over time, as it always has. Moving on to defense, well, about 30% of the allocation there, and that hasn't really changed much over time. I mean, 1% or 2% over the last 100 years. Obviously, we tick up in years of war, and there have been a few of those over time. But in years where we're not at war, which has been very few years, I guess, but major wars, it's sat around 26 to 30%. So we're right there around average. And so we don't see a whole lot of cut coming from defense. And then lastly, we're left with net interest at about 8%. Now, this is an area that can be worked just because as interest rates come down, the government's able to go in there and restructure that debt at lower rates. But again, that's only 8% of the whole pie. And so even though they could restructure it, maybe get it down to 5 or even 4, that's not, it's only about 10 or 15% of the total spend. Moving on to the next slide, what if we consider tax hikes instead? So forget about spending, because as you guys would agree, it's just not an area that we can work with. It's likely to come from tax hikes. So let's take a look at that. The federal government in 2019 generated $3.46 trillion in revenue. So by the way, the $4.4 trillion earlier, that was our spend. So we were at a deficit of $1 trillion in 2019. Our revenue was call it 3.5. If we look at what makes up that revenue, first of all, half of it comes from individual income tax. So when you go in there and have your taxes done, even though you may live in a state where you don't pay state income tax, everybody's paying federal tax. There is no circumventing that. And so 50% of that 3.46 came from individual income tax. And we have payroll taxes. Now, payroll tax at 36%, that's normally FICA tax, Federal Insurance Contribution Act, which is split between Medicare and Social Security. That's the systems that you pay into so that you can have those benefits at retirement. The others are corporate income taxes. This is about 15% total here across those 4 different colors. You had corporate income tax about 7%. They had excess tax and other at about 6%. Now we do see corporate tax likely to increase here, but we also believe that individual income taxes and payroll taxes will be on the rise in the very near future. Now Biden came forth with a plan here, as we saw over the last couple of months. We are still digesting that information because there is a lot there. Supposedly it's not to affect many people under $400,000. However, let's take a look at the next slide to see what they've done historically in times of trouble, in times where you have to make a decision between cut the spending or increase taxes, and if there's room there to increase taxes, right? Well, historically, this is the marginal tax rates since 1913, so 100 years. And before World War I, tax rates were very low, under 10%. What a world that must have been to live in. Now, during World War I, we can see that things spiked up dramatically, over 70%. They had to cover the cost of the war somehow. That came from mostly from individual income taxes. Now we can see that taper off as the war ended, and then we start to swing back up as the stock market had crashed, but more so as World War II began. And so again, we need funding there in order to pay for the war, and so taxes tend to go in the opposite direction, straight up. And for 40 or so years, they were very high, call it 50, from 1930 to about 1980 when Reagan came into office. And at that time, we all remember trickle-down economics. He took the office from Jimmy Carter, and their idea there was that if you would reduce taxes at the corporate level, then those corporations could use those proceeds to hire, and those hired individuals would generate income, and that income would be taxed, and therefore that revenue engine could get up and running. And so taxes came way down under the Reagan administration, and that continued up until present times. As a matter of fact, we are at an all-time low as far as taxes are concerned, or federal income taxes concerned, over the last 100 years. We're not as low as we were prior to the World War I, and not necessarily as low as we were prior to World War II. But we are historically lower than that 50-year span from about 1930 to 1980 before Reagan took office. Now, another thing to consider as well is since the Trump administration got into, back in 2016 when Trump took office, there was the Tax Cuts and Jobs Act, and that brought tax way down, even lower over the last 10 years than over the last 20. But that is set to really dissolve in 2026. So even if you don't agree with our sentiment about taxes needing to increase, in other words, we believe that the deficit will be solved by additional taxes, by raising taxes and not spending cuts, and not by cutting spending. But if you don't believe that taxes will rise in the near future to cover the deficit, well, come 2026, you'll be wrong, because taxes will increase due to the tax sunset, which is pretty much, they'll be reverted. Taxes will be reverted back to what they were prior to the Trump administration. So, for instance, we'll see things like the standard deduction right now, 12.4 for an individual filer, go back to about half of what it was. Sure, you're going to get some other deductions back in the mix, but it was, as far as tax tables go, rates were higher there. If you look to the right of a tax table, those percentages, you're going to see brackets. Those were also at a disadvantage for the taxpayer. And so anyways, those will revert back to what they were prior to the Trump administration in 2016 when they took over, and that's something called 2026 tax sunset. Now, let's move on to kind of the next section here. Now that we know or believe that taxes will rise because the deficit needs to be solved in order to reduce our debt, and they're not going to get it from cutting spending, because Social Security, medical, and defense will remain mostly the same. They're going to raise your taxes. So what we want you guys to understand is just the basis of how how taxes are formulated. A tax return, when you go in to pay them, how does that formula work? It's very, very simple. So first of all, here is the 1040 in its most basic form. So it all starts with income. You have your wages, your salaries, your tips. So this person will say made $10,000 for the year. As far as wages they were working part-time, say, $10,000 for their employer. They didn't have any tax-exempt interest, but that's another form of income. They did have some qualified and ordinary dividends, about $2,500 worth, so that's coming from their investments. They had pensions and annuities. This person is retired, so they have some pension and annuity income of about $36,000 per year. They have Social Security benefits as well. That's equal to $18,000 per year. This person is single, by the way, single and part-time, partially retired. They're retired, but they're working part-time. They had capital gains or losses of $3,000, so they didn't do so well in the stock market. They probably weren't working with Sunpath Financial. Moving along to other income from the Schedule 1, we'll say $700. That was from their tax refund from the state. And so their total income for the year was $64,200. Hopefully you guys can see that on the screen there. Now moving into how your income is offset, and it's done so with your deductions. And so when you go see your tax preparer, hopefully they're asking several questions about what you spent your income on so that they can reduce your income by that amount. You have something called adjustments to income, and that's what's also known as above the line deductions. And these things include educator expenses, health saving plans, IRA deductions, alimony paid, self-employment health, insurance, and a few of the others there that you'll see. And then on the right side, you have standard or itemized deductions. Now, if you didn't know, the government will give you something called a standard deduction. If your write-offs aren't greater than their standard deduction, then you simply just take the standard deduction. For an individual filer, which our example today here is an individual filer, the standard deduction is $12,400. If you're married, it's double that. It's $24,800. Now, if you're to instead itemize, if you have write-offs that are greater than $12,400, well, those would come in the form of some of the items listed here below. First of all, your health expenses above 7.5% of your AGI, adjusted gross income. So if you look to the left, those are your adjustments to income. After income's been reduced by those, that's your adjusted gross income. If you multiply that by 7.5%, your health expenses need to be equal to that or greater in order to write them off. This is why most people do not qualify to write off their health expenses, because 7.5% of their AGI is a pretty big number. They'll have insurance, and their premiums, although they do count, those won't even be enough over the year in order to be greater than that 7.5%. Anyways, health expense is a deduction, provided it meets those qualifications. Local state income tax is a deduction. You have your mortgage interest and property tax. You have a portion of your vehicle registration, cash and non-cash contributions. If you're tithing, that's a great one. Casualty and loss. And then you have miscellaneous work-related expenses, which only, those are only inclusive for the state tax return. Right now, they're omitted from the federal tax returns. And so, although we will look to get those back come 2026. So anyhow, you have your adjustments to income. You have $64,200. Let's go back to that. $64,200. And this individual had, oh, look at that. They had an IRA. And so that was an adjustment to income, $6,500. So we subtract that from the $64,200. And their adjusted gross income is $57,700. Okay, and then they had itemized deductions. They had a lot of deductions here, obviously. Probably own a home with a very high interest rate. Hopefully they have worked that down considering rates have been so low. Nonetheless, they had itemized deductions of $28,200. So they beat the standard deduction of $12,400 and they took their own write-offs. They don't get both, they just get one or the other. And then that is subtracted from the $57,700. And they have a taxable income, the number one factor for calculating your tax right there. It's probably the most important number on the tax return, $29,500. Why is that number important? Because it is what's run through the tax tables. Okay, so here's what they look like. I'm not going to spend a ton of time here. The way it works, simply, the first $9,875 this person earns. So the first $9,875 of the $29,500 is taxed at 10%. And then everything from $9,876 to that same $29,500 is taxed at 12%. And that's it. You add those two together and that equals a total tax down there at the bottom of $3,145. This individual owes that to be a U.S. citizen, right? That $3,145 is what is paid to the government for Social Security, medical, defense, and everything else the government has to pay in order to keep the economy running. $3,145 is the tab with the federal government for this individual. And that was simply taking their income, reducing it by an IRA, which was an adjustment to income, and then by their itemized deductions, which were greater than the standard deduction of $12,400. They had $28,000 instead. They took that, and then running it through this tax table, now their tax is $3,145. And that is the second most important number on the tax return. Obviously, the first one is taxable income, because the smaller your taxable income, the smaller your tax. But your tax is also important because that's what you owe. Now, moving right along, what happens with that tax? Well, your tax is reduced by any credits you might have. This person didn't have credits, but we'll cover credits a little bit later in the presentation. If they did, they'd be offset dollar for dollar. One of the reasons why credits, and you want to look for those if you can, is more valuable than really any deduction you could have above the line or below the line. So when I'm talking adjustments to income, the ones on the left we looked at earlier, or the ones on the right, which were your itemized deductions, those are kind of washed through that tax bracket. And so you're only receiving a portion or a fraction, a percentage of that write-off. Whereas with credits, it's usually dollar per dollar. It'll come right off the top of your tax bill. So you want to look for credits. Estimated tax payments and withholding. So some folks, they decide they would like, they decide to pay the federal government during the year. So people that know they will owe come the end of the year, oftentimes will make estimated tax payments. They'll pay in advance. Every quarter they'll send in a check to the U.S. government, and that's being used to offset the tax they'll owe at the end of the year. It just makes it easier for them, right? It's out of their hands and into the government, set there in a safe account to offset your tax bill. But if you're not a person that pays estimated tax payments, you definitely are most likely to pay withholding, federal withholding. So if you ever look at your W-2, or if you have a pension, it's like a 1099-R. If you ever look at those tax forms, there are a series of boxes typically on the right side. and it's usually like 1 through 20 or something. But that box number 2 is your federal withholding, right? And that number will be here. And for this individual, the example, they paid $2,200 worth of federal withholding for the year. And so what happens is that $2,200 is subtracted from their tax bill. If you paid it in through box 2 during the year, it's sitting in an account there at the IRS, and it's waiting and being used to offset your bill. Now, this person didn't pay enough in. It's called an underpayment, right? So here we see overpayment or amount owed. And the definitions of an overpayment is, well, how we understand it, a refund. So you paid in too much, but this individual didn't pay in enough, so they have an amount owed. So you can see that it's a rather simple formula. And if we look at some notes about the computation going back, the takeaways are it's your income less your expenses, and that equals your taxable income, and that's simply subject to those tax tables, which provides your tax. The lower or less taxable the income, the less tax you will pay. The higher your deductions, the lower your taxable income, the less tax you'll pay. More credits, withholding, and estimated tax payments, the lower the tax you'll pay. Okay, so these are things you guys want to jot down and take away from today, because this is how you will keep your tax bill low throughout retirement or even up into retirement. So moving right along, let's look at the most favorable retirement income stream. So this is kind of a big chart and rather small, so hopefully you guys can kind of reach in there and take a look. But first of all, we've split it between unfavorable and favorable. So let's take a look at types of income. Unfavorable, the first up there. Which ones are unfavorable? Which are taxed at the highest tax rate, also known as earned income tax rates? Well, earned income including wages, salaries, and tips. When you go work for an employer, you will be paying the highest ordinary income tax rates is what it's called, and you will be paying that. Social Security, pensions and interest earned, annuities, ordinary dividends, short-term capital gains, so less than a year, unemployment, rents received, royalties, and partnership income. You will also pay the highest taxes or ordinary tax income tax on withdrawals from retirement savings accounts, 401ks, that includes 401ks, IRAs, 457 plans, etc. Okay, so ordinary income tax, very unfavorable. And all of those income types you see there are exposed to those rates. Now, looking on the right, what's more favorable? What would we like to have in our portfolio when we retire, during retirement? First of all, we want capital gains from the sale of an asset such as a stock, a home, or a business, and we want qualified dividends. So capital gains from these assets typically will be long-term, and that's good because long-term capital gains you pay much less tax on than you do short-term capital gains, anything within a year. And then qualified dividends. So there's a stipulation, the difference between ordinary dividends and qualified is how long you've owned that dividend-producing stock before it pays interest to you. So I believe it needs to be 60 days before the ex-dividend date. There's 121 days up into that date, and mark me if I'm wrong, but I believe it's 60 days before your ex-dividend date. If it's owned, then you will pay, 60 days or before, then you will pay the much more favorable tax rate, the qualified dividend tax rate, as opposed to the ordinary dividend tax rate. Now, another favorable tax is on sale of highly appreciated inheritance for the step-up in basis. Now, they're talking about pulling back the step-up in basis, but as of right now, it still exists. What does that mean? Well, anytime you inherit from your family an account where maybe they had purchased it at a much lower value than it's worth today, well, when you sell that asset, will not be assessed tax on the difference between what they bought it for and what you're selling it for, but instead the price at which you received it, the fair market value on the day that you inherited that asset. So for instance, if your parents bought a home back in the 50s for $30,000 that's now worth $500,000, well, technically, if they were to sell it, there would be a $470,000 capital gain there. However, for you, if they pass that down to you after their death, well, then your new basis will be $500,000. So if you sold it the day after they passed, well, you pay no tax. But if, for example, it increased from 500 over the next year to say 550, well, you'll be subject to $50,000 in capital gains. Now, obviously, there's exclusions there. You can offset that with the cost to get the home ready and the commissions for the brokerage who is helping you sell it, the real estate agent. And then you would have, if you're living in the home for 2 out of the last 5 years, you would have a $250,000 exclusion per person, up to 2, so you and a spouse, for a total of $500,000 if married. But other than that, you would have a $50,000 gain there you'd have to pay taxes on. So that can be a very favorable position for families. You also have tax-free investments, including municipal bonds. Well, interest from municipal bonds. And so if you guys aren't aware, you can buy bonds from a municipality, and typically when you do, they are tax-free on the local, state, and federal level. And so although they will be used to calculate your combined income for your Social Security, well, there's something called work penalty, and they get added in your combined income to figure if you'll pay a work penalty as it relates to Social Security. So in one way, there's only one disadvantage I can think of, and that's it. But excuse me, I'm digressing. Back to it, municipal bond interest is typically tax-free. And then you also have tax-free ETFs. So if you're not familiar, ETFs are like mutual funds. And then you have Series I bonds, which tend to be tax-free. We can't solicit them as advisors, but you can buy I bonds online. And I suggest if you haven't looked at them, you do. Typically, the interest rate, the yield is more favorable than many other bonds, not to mention they're tax-free. Distributions from Roth IRAs or cash value life insurance policies. So cash value life insurance has gotten a bad kind of name over the years. But anyhow, if you do have one, there's cash inside. The great thing is you can take that via a loan. Typically, the company will offer, they'll charge you 1%, but they'll credit you 1% because there has to be kind of an APY associated in order for it to be considered a loan and be tax-free. But that's one method. Roth, if you have one, that's great because, as you know, you're taxed now, but you're not taxed later. So you're not taxed on the cost basis because you paid tax on that, but you're also not taxed on the interest that you earn over time. And so another area I'll say, too, that we've been kind of working for clients is conversions, Roth conversions. So taking an asset like an IRA, something that you haven't paid tax on, paying the tax now through a conversion, just pay it, and then you would contribute that to a Roth. It's called a backdoor Roth, a Roth conversion. There are different names. But the great thing about that is that even though you paid the tax now, if tax rates go up in the future, you've already got them out of the way. All of the growth from that point forward is tax-free. We recommend that you do sit and talk with a professional before making that decision. Because there is more that meets the eye there. Some people make this decision and maybe they pay an average of 25% to get the money from one place to another. Say 25% is the total they pay to get $100,000 or $1 million, let's say, from one account to the other. Well, they just shed $250,000. If tax rates in the future don't increase beyond that 25%, if they stay at 25% or they are lower, or they go lower, for a variety of reasons, not just because the government would increase tax to offset the deficit, but also because your income comes down by half usually when you retire. You don't need as much income when you're in retirement as you did when you were working, or you won't receive it at least, so you better cut your spending. And therefore your taxes would be lower. And that put you in a bad situation for someone that went off and paid 25% now to convert, and now has an average effective tax rate in retirement of 15%, well, that wouldn't have been a great decision. So you need to make sure that that's going into a sophisticated planning software and that you're speaking with a professional before making the decision, but nonetheless, it is an option. So moving right along, there at the bottom, we can see associated tax. The unfavorable are subject to, like I said, more than once now, ordinary income tax rate, and then favorable are lower tax rates, and it really depends on the income type and, well, not your income type, but your total income, and then your filing status. Now let's take a look at the tax rates. How do they differ from one another? So we saw this table earlier. This is the ordinary income tax rates that we ran our taxable income through in the example above. And then we have on the right the favorable income tax rates. Now, big difference here. So we see from $0 to $39,375 as a total income. So if your total income was from 0 to 39, well, then you will pay no tax on those more favorable income tax rates we saw, or incomes that we saw. From anywhere from $39,376 to $434,000. So most of us are going to fall right in there, about 40,000 to about 400,000, 15%. So that's pretty awesome. 15% is usually going to be lower than the 20% you'll have to pay on short-term capital gains, for instance, right? 5% less can go a long way, especially when we're talking tens of thousands, if not hundreds. And then we have 20% from 434,000 and above. It's going to be 20%. But that can still be more favorable than that same person having to pay ordinary income tax rates, because for a person that's making over $430,000 a year, if we look on the left, well, they would be up as high as 35, call it, percent. So they'd be knocking that back by about 15% if we're looking at it that way. All right, moving along to strategies that you can use to reduce your tax bill. All right, so types of income and their associated tax. So first of all, one of the income strategies you might consider in retirement is following liquidity priority. And what that means is that if you start with cash, for instance, so say you get into retirement and you have some Social Security, forget the pension for now, let's just say Social Security, and that's all you have, and you're $1,000 short, let's say, every month. The difference between your Social Security and your expenses is not enough, or there's a gap there, right? Social Security is not enough to cover your expenses. There's a $1,000 difference. So you'll need $12,000, 1,000 to multiply by 12. $12,000 will need to come from your retirement savings in order to make up that shortfall. What we suggest is you take from any cash positions first. So when we say liquidity priority, what we mean by that is where the money comes from in order to cover that $12,000 shortfall. And what we suggest you do is take from any position that you're going to pay the least amount of tax on first. And typically you will pay the least amount of tax on a cash position. So savings, for instance, if you have a large savings, we have clients with savings, $500,000 plus. It's just sitting there and they don't want to invest it because they like security. At least that's the assumption they're under. And so it is what it is, right? But start there instead of your qualified or retirement savings accounts like a IRA, for instance. So you start with cash. Now, once you bleed your cash down to at least 6 months of your expenses, right, because you always want to have at least 6 months of your expenses and savings, then you'll start on the next bucket, and that's non-qualified. Now, what does that mean? This is like a brokerage account, an account that you might have stock positions in that you pay tax on anytime you sell and there's a gain. Usually you'll pay tax on these things annually because you're either doing it yourself or an advisor's trading for you, and he's looking for opportunities in the market, and so he's in one place and then he's out another and there's a gain there. Well, you pay that annually. It's not like an IRA where no matter how many times you trade, it's just deferred. It's deferred until you take it later on when you'll pay ordinary income tax rates, regardless, right? And so you have non-qualified, you want to take from there next. Most of that is going to be long-term. If it's not, tell your advisor that he needs to hold off on the trades for whatever's to come. At least on the portion of cash you need to hold off on the trades for that year, so you can pay the lower tax rate. The next bucket is qualified. So after you've run those two mostly dry, other than the 6 months of expenses in the cash position, Then you'll have your qualified position, your IRAs, your 401k, 457, simple, SEP, you name it, anything you haven't paid tax on, anything that's tax deferred. Then you will begin to take income from those buckets. Okay, so moving right along. Reduce income to cover just the necessities. Don't take more than you need. Some people, they have this idea of spending down their retirement assets as quickly as they can to get them from those retirement savings positions or the investment accounts into their savings account where they feel safe. Don't do it. You're going to pay a lot of tax, more than you should. And for those of you who for those of you who aren't spending down your assets in order to get it from investments to savings, but instead just want additional income, try your best to limit the amount that you're spending, not just because you need the assets to last you the next 30 years, but more so because you'll save on taxes, and which will further how long they'll last. Eliminate debt and expenses to withdraw less from retirement savings. So this is a big one. If you have cash positions, oftentimes when we're sitting and building plans for clients, we'll see a bunch of cash, then we look on the right side of the ledger and we're seeing a bunch of debt. Some clients will have $50, $100, $200, $300,000 left on their mortgage, but they have $1 million in savings. Well, what we'll recommend is simply pay off the debt. And if your debt is much smaller than that, but you have savings to cover it, you may consider paying off that debt. Why? Because if you do, you won't be as dependent on pulling income from your retirement savings accounts or your brokerage accounts, your non-qualified and qualified, which pushes up the amount of tax you're going to pay. Once you get that expense paid off, that debt is gone, you don't need to pull as much out of those income sources to cover that debt, and therefore you pay less taxes. So that's another income strategy we use for clients. Portfolio strategies, so this is within the investments. You could purchase and hold dividend-producing stocks for qualified dividends. Okay, so, again, 60 days from the ex-dividend date is when you want to buy them. But if you don't, that's okay. You'll pay ordinary for however long it was that you didn't own them as qualified. And then going forward on that next dividend date, then those will be considered qualified. But the idea here is that you want to hold these stocks. You want to find, usually a big blue chip company, and even if you're doing some active trading on the side, you would have a portion of your portfolio dedicated to, dividend producing stocks that you're going to hold. And from those, not only will you see appreciation, but you'll also see the dividends as income, and at the most favorable rates, because they're qualified. You've held them, you haven't traded them away. Now, moving on, hold assets for more than 1 year to qualify for long-term capital gains. As we saw there earlier, long-term capital gains are better than short-term capital gains, and they're better than ordinary income tax rates. Okay, so which tend to be the same thing. So short-term and ordinary is going to be the same thing. But long-term, greater than a year, when you hold an asset, you're going to, when you sell it, pay long-term capital gains, and that's what you want. Now, moving on to municipal bonds, I-bonds, and tax-efficient ETFs. This is a portion of the portfolio that we create for clients just because they're tax-free entirely. And so that is another great area to find yourself investing so that you can avoid taxes come tax time. IRA to Roth conversion, I spoke on that earlier. You guys know what that is now, where you are simply taking a qualified position, something you haven't paid taxes on yet, and you're paying the tax now, you're getting it out of the way, and you're moving that over to a Roth. Because why? A Roth, all the interest earned in there is tax-free. Now remember, the number one rule, if you want to do it yourself, you don't want to hire a professional like us, the number one rule is you need to make sure if you're going to convert to a Roth that the tax rate you'll pay today, right? Let's say you take $1 million out and you're going to pay 40%, or you structure it over 5 years to get it down to say 30%, right? 30% over 5 years, you take the million, about $200,000 per year to reduce that tax liability annually, and you're converting it over. Well, let's say it's 30% total is what you paid on that $1 million to get it from the IRA to the Roth. Well, you need to make sure that your annual effective tax rate, talk to your CPA, that your annual effective tax rate is equal to or greater than 30%. Otherwise, that decision will not have benefited you. Okay, so it's only if the benefit of doing a conversion is if the future tax rates are higher than today's tax rates, including your adjustment to income. When you are younger, you will earn more and you will pay higher taxes. When you're older, even if the rates go up, your income will reduce. So even if the future tax rates increase by double, but your income goes down by half, you'll be right back to where you were when you were younger, and that Roth conversion may not have made sense for you. So just be careful. Run the numbers, get them in a professional system. We have and use the industry's best retirement planning software, and we help people make the decision, whether it's right or wrong. You're more than welcome to reach out. Anyways, last piece here, loans from cash value life insurance, whole life, index universal life, variable universal life. These are these are life insurance policies that have cash accumulating in them, and you can, via a loan, you can take that cash and use it to supplement your retirement income, or you can use it to grow your assets. As a matter of fact, some people, instead of doing an IRA to a Roth conversion to a Roth, they're converting to a cash value position, a cash value life insurance position. And one of the reasons we see them doing that is not only because they get the tax-free status of the Roth, but also because there's other features and benefits added to a life policy that you won't get with a Roth, such as long-term care. You have a 70% chance of a long-term care need after the age 65, and that's one way that's over the last 15 years, one of the ways, there are several ways people will run out of money during retirement. What can decimate your retirement? And one of the ways is long-term care costs come into play, where for males, it's about a 2.5-year term, right? They're going to go into long-term care and they're going to need assistance for about 2.5 years. And it's about a $300,000 cost. For women, it's about $500,000. They tend to stay in the long-term care need for about 4 years. So it's very costly. But if you have a cash value life insurance policy you converted to that includes a long-term care rider, you can now use the face amount, the death benefit of that policy to pay those costs, okay, instead of your retirement savings accounts. So that's another reason why people are converting instead of to the Roth. They might do a split, or they might do all, or when I say all, whatever they decided to convert, not all of their IRA, because you shouldn't do that. It should be you should have 3 buckets and usually 30% in each. You have what you pay on annually, that bucket, like a brokerage account. You have your qualified, which is deferred, and then you have your last bucket, which is you don't pay tax. It's tax-free. And so anyways, what I'm saying is on that tax-free bucket, you might have a split between a Roth and a cash value life insurance plan where you've done equal parts to both. Moving right along, there are credits. I mentioned earlier, one of the greatest strategies that you could take advantage of, so keep your eye close to it, are credits. And that's because, again, it's dollar per dollar. Whereas when you have itemized deductions such as mortgage interest and property tax registration, those things come off the top of your income, but all that's run through the tax table, so you're only receiving a small percentage of the write-off. Whereas if you have a credit, it's dollar per dollar. It's after the tax is calculated, that bottom line, that $31.45 from earlier in our example, if he's got a $1,000 credit, it's $1,000 right off the top of that $3,000 tax liability. And so you want to take advantage of credits wherever you can. You have family and dependent credits, elderly and disabled, child tax credit, and earned income credit. Many of you have seen child tax credit over the years. A great one is if you're caring for grandkids. Well, if a large portion of what you're spending is going to housing those children, then you should be in close connection or conversation, I should say, with your children, your daughter or your son, to claim that child on your tax return in order to get that $2,000 tax credit. So moving right along, the EIC is if your annual income is at lower than what's kind of average, the government gives you a credit that's higher than the child tax credit. Income and savings. So savers, you can do foreign tax savings, and you can do excess Social Security. Those are two credit strategies. And if you guys aren't familiar with what these are, you're more than welcome to reach out and I can send you some information on them. Or you can simply look on the IRS website. I mean, if you type in IRS credits, for instance, in Google, this will pop right up for you and it'll give you explanations for each. Homeowners, this is great. You have energy efficient credits. You have low income credits. So energy efficient would be if you installed, I think they have like nowadays the Tesla battery pack, right? Where you can run your solar, which is another tax credit, into a battery pack that holds your energy to, to be used for your household appliances and everything else. There's credits there. There's EV credits for electronic vehicles. So look for, well, that wouldn't fall to homeowners, but anyways, there's dual pane windows that are gas infused. I don't know all the technical terms, but homeowners, you want to look for any type of credit, energy credit. You can use that on your tax return. So I see EV was not mentioned there, although I did. Electric vehicle, you want to look for that. I know Tesla has, I think, up to $10,000 rebate or tax credit, I should say. Healthcare, you have your premium tax and you have health coverage, and then education, if you're going back to school and it's never too late, you have the American Opportunity credit. And also, if you're taking care of those grandkids and they're going to school and you're paying the way, there's a potential for you to take that American Opportunity on your tax return. So moving into capital gain strategies, I know we're going rather long here, but we're about to wrap it up. Capital gain strategies: sell highly appreciated inheritance at step up in basis. So we mentioned this earlier. This is if you inherit, if any of you inherit actually now, I would say more than ever, a real estate property, be it commercial or residential, you might consider selling. We're at levels in the market that we haven't seen ever, even pre-2008. It's a great time to sell. It's a seller's market. People are getting 2 to 5% above ask cash offers. The nice thing is if you inherited a home recently and you sell now, guess what? All the cash is tax-free that you receive from the sale of that home, less any mortgage that might be outstanding. But you will not have to pay tax on your capital gains. There will be no capital gains. Tax harvest to offset gains. So when you're selling, so if you have a brokerage account and you've got a gain for the year, you're always going to have winners and you're going to have losers in a portfolio. So you can offset your winners with your losers. So what you do is you go ahead and lock in your wins, right? You sold the winners and now there's a tax bill because you're going to have capital gains. What you can do is sell the losers, the ones you want to get rid of because maybe they've been stagnant for a period of time, or for whatever reason, after doing your research, you find that there's just really no future for this position. You sell them and that loss will offset your gains. So that's one of the methods we use for clients here when we have a big year, for instance, a year where we've just done very well in the stock market. Maximize rental write-offs to reduce capital gains and income. So when it comes to owning properties, you can really take advantage of a lot to write off there. So you just want to make sure that you're going as far as you can. You want to really grill your CPA or tax preparer and make sure that they are doing everything in their power to write off as much as they can, because that loss will carry over and it will reduce your annual income. And again, if you're in the lower, that's what you want. The whole name of the game of taxes is reduce your income. Lower income, lower taxable income, lower tax, and that's what you want. Now, some examples of things you might consider is amortization. Make sure they're amortizing the property and taking that as a write-off. Repairs and maintenance, keep track of all of them. Doesn't matter what it is or how small, make sure you get it listed in the expense worksheet of your rental properties and any other expenses that you might incur. Now that is going to wrap up today's presentation. Hopefully you guys were able to stick around. What I do want to do is I want to end today with an offer for you guys. It's a 10-page custom tax report. What we do is we get on the phone with you for a few moments and we take some notes about your income, expenses, assets, liabilities, and we will create a projection. And we're able to, the software is detailed enough to computate your tax over the next 20, 25, 30 years. And we kind of take a look at a big picture. We take a look at your lifetime tax bill or liability. And then we look at ways that we can inject these strategies mentioned here today in order to reduce that lifetime tax bill. And by looking at it on such a broad scale, you're able to see total savings. Sometimes people think, oh, well, I'm only going to save just a little bit here every year. Maybe that doesn't make a whole lot of sense for me. But if you look at that over 10, 15, 20 years, especially if you're reinvesting what you're saving, well, then that can add up to be a significant amount. And for some people, this can mean thousands, some tens, or even hundreds of thousands. And so this 10-page custom tax report will give you enough insight, plant enough seeds to kind of help you decide what direction you should start to move into. And with any of those solutions, we can help you guys. We are a retirement planning and wealth management company with a tax background. And so not only do we have access to CPAs and tax preparers to help us build these plans, but we are able to carry out the recommendations we make coming from those resources. So if you would like to get your custom report, let's see if it is here. Ha! There's Evangelina. Hi, Evangelina. One of my favorite clients. She's on here saying hi today. She attends all of our webinars, and we absolutely love her. So thank you, Evangelina, for saying hi. And I'm going to find a link for you guys. As a matter of fact, I'll just put our email. If you would like to get your presentation, I'll just say it out loud, to get your report, it is contact@sunpathfinancial.com. So that is contact at Sunpath Financial, so sun like sun in the sky, path like a path you walk down, financial.com. And you can simply say that you would like to receive your report. I'm going to see if while we're waiting I can't log in here and supply you guys with the link to Calendly. Let's see here. Give me just one moment, please. All right, I've logged in. They're going to let me chat. Okay. All right. So what you'll do is you'll end up clicking on this link, and that link will take you to a page where you'll just simply give us your name, your email, and your number, and we will reach out to you. A planner will reach out to you, and we'll begin to gather your income and expenses. And within a week, that's about a 15-20 minute call. And then within about a week or so, we will reach out. A planner will reach out or back to your planner with a presentation. So let me see if I can't get this URL for us. Calendly. Calendly. Yeah, here he is. Okay. Let's copy it over for you guys. Hey, even I am technically challenged with computers at times. There's just so much now. Paste. And there you go. Okay, perfect. So that link is there. All you have to do is click it. It'll open a calendar for you guys where you can fill out your name, your email, and your phone number. And then it'll ask you to set a date and time. And at that time, on that day and time, we'll reach out to you and we'll begin gathering some financial information in order to build you a plan. A 10-page, it includes a 10-page custom report, and we'll walk through it together. A cool thing is we'll have your current and lifetime tax liability report. That's the one that we usually start with, so you can see how much tax you're going to pay over the next 15, 20 years. And then with that, we'll have a report with tax reduction strategies, and that's just kind of give you an idea of things that you could use for your situation to reduce those taxes. And then on the final page, there's a report after those recommendations have been implemented to show you the total tax savings over that period of time. And so it's a great way to get started on a tax strategy. So simply click the link, Calendly, fill out your information, and we will reach out to you. I'm going to go ahead and wrap it up today. It doesn't look like we have any questions on the social platforms, and I got to get ready to get out of here for Turks and Caicos come this next week. Thank you guys for joining us. Again, if you need anything, you're more than welcome to reach out to us via email, or you can always call us. Other than that, if you'd like to take advantage of the offer, it's there. Thank you guys for attending, and we do look forward to seeing you in the next webinar.